What's up, everybody? Welcome back to the Kansas City Commercial Real Estate Market Pulse. Today, we are joined by the Oracle of Austin, Ari Rastegar, and he's built one of the fastest growing vertically integrated real estate platforms in the country. You can see him all over national news, the TV. So go check him out. This Sunday, you said, right? This Sunday,
Yeah,
go
this
check it
Sunday.
out. Yeah. And, look, guys, I bring on people that have powerful stories. We aren't going to spend a whole lot of time with Ari's story today. It is documented well. Go watch some promo videos. You can see it. We want to spend time giving you the nuts and bolts because I host this show for the last 7 or 8 years for one reason, and that's because clarity beats noise. You guys need no more headlines or opinions and predictions about commercial real estate. You need grounded, market specific insight from people actually doing the work. So that's what we bring on here today. So we can cut through the national narratives, explain what's actually happening on the ground. And we're helping investors, developers, operators, owners make better decisions with real data and real context. My team is here. We're adding another person here very, very soon at the end of June. New grad coming in, joining the team, going to be hustling the industrial outdoor storage. I told him, and Parker, if you're listening, I told him, you're going to have to get in the car and go knock on the doors, brother, because these people do not answer their phone. And we got somebody here today who has literally knocked down doors. And you can check his story out. But the one thread that I will pull out, some of my favorite people to hang out with, to converse with, to have on my show are immigrants. And I know your dad is an Iranian immigrant, and I can only imagine how he parented, and it's very strict. Be a lawyer, do whatever you want afterwards, but be a lawyer, right?
Now, you said it nicer than he did, but yeah, basically.
Yeah. But that's what we're taught, right? Is be a criminal defense lawyer and listen to and defend and or have to deal with everybody else's stress, and you're gonna make it. You had a different route, and I love this because you found your passion and now you're executing at scale. So we're going to talk about your book today. We're going to talk about a lot of different things, but I get questions quite often because I have projects in Missouri, Kansas, Nebraska, Iowa, Ohio, Arkansas, and Oklahoma, but it's all kind of right there in the Midwest. So let's start here.
That's that's not easy.
It isn't easy, but I can at least still drive to most of those places. I get the old full self-driving Tesla out and just push the button and have it take me there. That's pretty cool, by the way. So I don't know if you're an Elon fan or not, but I'm reading the Book of Elon by Eric Jorgensen. And he is a phenomenal aggregator of information, and I'm learning a lot from Elon right now. And I'm just tracking TerraFab down there because that is just fascinating. So you're right there in the middle of it all. But you've scaled to 38 cities, 13 states, 5 million plus square feet, man. Just give the listeners some insights in how to do that and how you did that and why.
Well, a lot of failure. I mean, let's start with that. I don't think anybody really wants to hear that, but I wrote a whole book about it. And
yeah,
failure is how you learn. I mean, you fail forward. And when I first started, as you said, I was a corporate litigator. I practiced criminal defense law. I was an attorney by education, but I studied English literature, and I'm a history guy. I'm a nerd. I read everything that I possibly can. And when I first started, I was in New York. I worked for some of the biggest names in real estate in the world, without hyperbole, literally. And over the time working with them, because learning, especially in a business that is such specialized knowledge, there's a reason why for thousands of years there's been apprenticeships where you learn these tried and true things. You learn a trade, for lack of a better word. And real estate was always meant to be the beginning point of a fully integrated investment firm. And that's another discussion. But the way I started was because of those relationships. I knew some of the best operators in the
Mm,
country, because some of the stuff we were working on was more on the debt side. It was really around CMBS, around financing. And because of financing, you hit a large spectrum of borrowers. And I wasn't necessarily in that business. My investors of my entertainment company were all in real estate, and you'll read about that in the book if you get bored enough. I say it's maybe worth the $10 on Amazon. But because of those relationships, I started to learn specialized knowledge
mm,
around a little submarket in Hartford, Connecticut, or
yeah.
it's not just. And what you said earlier, I really love, and I think it's very important, is the national average metrics as a professional investor are worthless. I mean, other than some of the debt indicators and the spreads on SOFR and how you're procuring financing and stuff, yes, there's applicability there, but even market to market, there's going to be 10, 15, 20 basis point spread on, how you procure financing. But really subject market expertise around not just, let's say, Austin, Texas, where we own tons of stuff, but just the submarket, the Mueller district, the, downtown corridor, like in New York City's a great microcosm, right? Like you
Mm,
can be in one part of Midtown and it's like A plus, you go one block over, forget about one avenue. One avenue is Siberia, to how
yeah.
different the fundamentals, the mechanics, the players are. And so it's very important, and I like that, digging into the details of the subject matter of that street, that area, those nuances is so critical when you're making these types of investment decisions, especially when, we have mostly public pension fund institutional capital. We have hundreds and hundreds of high net worth individuals because we started with nothing. But the bulk of our capital is public pension funds, insurance companies, firefighter, you name it. And at the beginning, it was all about risk mitigation, and it gets more and more around risk as you get bigger and bigger. You can think about how much money you want to make and all that kind of stuff. That's great. But this whole business is about not losing money, or doing the best you can to not lose money. And the way you do that is through either asset allocation, diversity, and any ways you can mitigate your risk. So when I started, I had never built an apartment complex. I'd never built a 300-acre master plan community or a 1 million-square-foot industrial facility or office buildings and all the stuff that we own and we buy. So I went to some of the operators I knew through just personal relationships and
Mm,
meeting through the people I knew, and had them say, "Hey, I'm doing these 3 apartment complexes in, Connecticut, and these particular guys I'm talking about are still friends. They grew up in this one neighborhood. They were buying they lived there 20 years. Their dad lived around the street. He was in carpentry, and they basically like, hey, we're going to buy these 2 apartment complexes. We need, 20 million bucks." And I basically was like, "Hey, well, can I put in $1 million?" Because around that market, those demographics, that underwriting. So I went back and put my lawyer hat on and formed an LLC, did my Reg D filings, did my blue skies, did my homework on the structure, found a great CPA, and formed an LLC and acted as a fund to fund, and just formed an SPV and went to a third-party administrator at the beginning, because all institutional capital is around how you're a custodian of money. It's not your returns, your things, deals go up, deals go down, but how you handle money, having audited financials, audited track record. Those risk controls are what attract institutional money, not making the biggest return. Yeah, you need to should make money clearly, but how you make money is more important to institutional investors than, and I had an advantage of being an attorney to think about that. So I started off and met these individuals that were really good at this Class B, Class C multifamily rehab work when rates were at 0 back in 2020, 2012, baby. And then there's some groups that were doing great self-storage work, and I knew them again through some of the
mm,
people that were financing them. And I went one by one to tour the cities that I understood, whether it was, Phoenix, whether it was Las Vegas at the time, whether Dallas, Austin, San Antonio, Houston, whatever the parts of Florida, New York. And I focused on raising basically their co-invest capital and putting them alongside subject matter expert operators. And
yeah.
that's how I spent the first 5 years of my firm, is in getting to know them, traveling them, talking with them, being with them. So I didn't have to take execution risk. I got to build my book of LPs. I got to look at the reports. I got to sit at the table, and I got to understand those markets. And around 2015 or so, When rates were zero and markets were growing, and when rates are low and money's flowing, people look a lot smarter than they are, me included. And a bunch of them started selling, and I woke up one morning, basically over the course of a couple of weeks, with like 20 SPVs from 30 different cities that were all basically selling. And I had effectively access to a very large chunk of money from putting out small tranches over years. And I got to start looking at the fundamentals of my hometown, which was Austin, Texas. And to me, when you really looked at the math of population migration trends, what ended up being Tesla's global headquarters, the site of the new will be the new Terafab, Dell's headquarters, Whole Foods. Just keep going. Oracle, keep going. Google's second
Absolutely.
largest office, Facebook's second largest office, and it's a beautiful city. And so I had hometown advantage. It is home. My kids are here. So we started to buy hundreds and hundreds of acres, quite literally. And now, if you build everything we own left, not counting what we've already built and it's cash flowing, it's probably $4 or $5 billion worth of product from land that we've been holding, because it takes time. Real estate happens in decades. It doesn't happen in days. But the scalability piece, were strategic partnerships, call it fund to fund SPV models, that allowed us the luxury of learning how to run these deals, how to underwrite these deals, asking the questions without taking that type of execution risk, and then easing into it. And even now in Dallas, we own a site that is across from Goldman Sachs's second largest office in the world, under construction, Bank of America's new headquarters, right on McKinney Avenue, which is the Park Avenue of Dallas. I mean, it's the richest corner in the whole state of Texas. It used to be a nightclub 20 years ago that kicked me out for having dirty shoes. I still have the shoes, by the way. 15 years ago, then 8 years ago, I went and bought the building, and took me 8 years to rezone it from 20 feet of height, no residential, to 400 feet super tall, which would be the tallest building in Uptown, to do a 5-star hotel mixed use, kind of project. And a project like that, we're going to co-GP. Like, I've never built a 400-foot super tall. I'm not taking an urban environment, that many people, that many workers. So we're going to find a strategic relationship. We'll put up, 20 or 30 million bucks from our balance sheet, co-invest with it. We'll be a part of it. But the key to that scalability, to the core part of your questioning, is these strategic alliances. I mean, and if you have a co-GP that just wants to have control and tell you what to do, but they're not real estate professionals, that's bullshit. But a great group, like, we work a lot with Related Fund Management in New York City. I mean, they're one of the best operators in the world. They built Hudson Yards. I mean, unbelievable people. Jeff Blau's a brilliant CEO. I mean, they're just great people, great operators all around. And so when those guys are around, they've taught us so much. Like, yeah, they've done a bunch of stuff with us. It's been wildly successful, but you learn from them, and you have to know what season you are in life, and if you're in an apprenticeship, even, if you start, the biggest tragedy can be you start making too much money too early, that you think you know more than you do. And when you have that level of humility, and humility is not, to be clear, just being like, sitting in a corner and being all sheepish. Humility is thinking less about yourself and more about the deal, more about people, more about the mission, more about the thing, because I don't need to be right, but I do want the fucking right answer.
Right.
And so that comes from that alliance. Scalability inherently is about people, because you can be the best shooter in the world, great, but until you learn how to be a coach or be an owner and coach people and build people, it's never going to scale to that level. So a big transition for me was, when I look at what makes a great founder, what makes a great founder, and you've done a great job, Logan, the stuff that you and your team are doing, and you're dedicated to it. You spent years doing it. You become a master of your craft. Being a founder takes, grit, resilience, perseverance, vision, right? Hard work, wearing a lot of hats. I'm sure you have to be the tech guy sometimes, and you're the sales guy, and you emailed me yourself, to come on the show. So you do a lot of things. Well, everything that makes a great founder, everything makes a terrible CEO. A great CEO doesn't do all the work. They train people. They create systems, processes that can be scaled and repeated, and they might create this do but. Great. Now put a person here and hire 800 people to do it, because you can only scale and push so much, because even as great as you are, as persistent as you are and hardworking, you have 24 hours in the day.
That's
And
right.
so all of these concepts about scaling beyond one market, as this says, or scaling beyond yourself, scaling your company, is stepping out of it and saying, how can I build a system, not do the work? Like, yes, there's a time when you have to be the laborer, you have to do the work. I flip burgers, I've been a rich man, I've been a poor man. But the difference there in mentality was training people and creating systems, or me doing more work. And me doing more work is inherently finite, and scaling and having people and systems and process is inherently infinite.
Absolutely. Well, big shout out to Yumer Shaw dropping in, just saying, hey, hope you guys are doing well. Hope you're doing well too, my friend. Ari, thank you for that. I appreciate you working that in. And one thing I wanted to double click on just real quick is I see a lot of people chasing the trends of the asset classes, right? I sit in the broker seat and the owner seat, but man, when something's hot, let's talk about it. Industrial outdoor storage or self storage or whatever it is, right? Like you went a different route. You focused on the strategic relationships and really building those out. So I just want people to make sure they hear that and they double click on that, because that's what really stood out to me right there.
I appreciate you noticing that, and kind of just unpacking that a little bit. We've obviously invested in basically every asset class. And let me unpack why that is, because it wasn't, because you're right. You have multifamily guys, you have industrial people, you have storage people. As a general rule, they're very insulated pillars, and there's a lot of benefit to that, right? Like you really learn systems and processes, and great. But I would argue being in one asset class like that is also poses more risk, because like multifamily has been eviscerated, because so much of multifamily on a beta trade is rates are low, and as rents go up by 10% a year and you can refinance at XYZ cap rate, you can go. Well, we pulled out of anything that could be simply beta, and beta is basically just letting the market rise. We're alpha investors. And what I mean by that is we focus on entitlements and zoning as a core pillar of everything we do. So we'll go find irreplaceable pieces of land in areas that we believe have the growth metrics in general. And we're first agnostic. I'll go to an area and say, dang, this area is going somewhere. It's turning XYZ for a reason. And we'll see if we can buy the land or look at what the cost of the land is. But where the real value creation is in the stepped up basis between they saw the land, or an old community saw the land as a restaurant.
Yep.
Okay. This was a taco diner in Austin. Okay, great. For 50 years, it's a great taco diner site. But on a half-acre site in downtown, if I go through a zoning thing, I can build a 30-story apartment complex when the whole market is pricing it as a taco stand, as a big example. So we ended up focusing more on the highest and best use case around the land or around the asset. We've bulldozed old Class C apartments and turned it into townhouse development. We've taken farms and made them elementary schools and multi-thousand house communities, thousands of apartments, commercial space, because you got to go in our mind of look, you honor the past while you build the future. You look to the past of where it was, and then you're looking to where the market is going, because if you stay in what the trend is, or what it is, oftentimes you're too late. So as a broker, if you're a broker, and there's a lot of ways, or a debt broker or a real estate broker, yes, I think there's a great case to be made that if that's what people are buying and you can sell that stuff and you can get a commission, that's fantastic. We're not flippers. We are long-term owner. Our deals are not in funds. We buy them and we can keep them forever. Like we make money on our promotes. We invest in the deals ourselves. We are long-term holders. And when you're a long-term holder taking long-term value creation, think real estate meets Berkshire Hathaway, you need to be in something that has the ability to last 5, 10, 15, 20 years. And when you have the discipline to do that, the irony of it is you can sell out at 5 and probably do pretty well. But if you're just looking at the headlines to make a quick buck and you don't have a long-term vested interest, there is a place for that. There's an absolute place at a time in life to make great current income. But if you're trying to accrete long-term value creation, that short-term timeline by very nature erodes the long-term value creation that patience creates.
Absolutely. Well said. And you're speaking my language. We take a lot of agricultural land and re-annex it, rezone it to get it entitled by right, and either build industrial, or what my
Right.
favorite focus right now is in Kansas and Missouri, mostly Kansas, is data centers. And so there's a big opportunity to create that alpha and be able to take something, and you're actually forcing a lot of value in those scenarios. So the difference, let me just break this down for folks. The difference is I'm a multifamily operator. I'm a self-storage operator. I have to go find all of the properties that exist today and compete in that marketplace. What Ari is saying is they look for the best sites in the best locations in the neighborhoods that they know. And with a long-term perspective, they're willing to put a higher and best use on that site to generate infinite type of returns here. It's a totally different model, but you have to have what Peter Lindemann calls, capital, courage, and a long-term perspective. And not a lot of people in this industry do, my friend.
Yeah, it's and look, I think there's not any strategy, whether we're talking about the broker, and I'm picking on brokers for a second, but it's incredible business if done right. You can make an incredible amount of money, quite frankly, and your income, where you make your income, is not necessarily your investments, but the timeline of how you look at things. There's guys that have flipped stuff and done really well. I don't like flipping for myself because I think it's higher risk, and I don't like paying short-term capital gains. So
Sure.
even if I do incredibly well in a flip, I still have to pay too much in taxes. So the point is knowing what your model is, and most importantly, if I can give any piece of humble advice in my own failures along the way, is having some sort of diversity, whether it's
Yes.
diversity in how you hold capital, diversity in where your asset classes you invest in. Maybe some are cash flowing, some are development, some are industrial, some are storage. That's to you to figure out what that means for you. But in my mind and in my experience, doing one simple thing in the investment business as a general rule, if you look at the greatest investors in the history of mankind, I am not one of them. There's
Yeah.
always asset allocation, which is the genius. Like whether it's how Ray Dalio thinks about it in terms of
Sure.
buckets, non-correlated assets going into gold versus this or that currency. And there's a million ways to skin it. But once you start looking from a place of diversity, and more importantly, thinking more about how you could lose money and looking truly at downside risk protection, in our experience, the probability of making money has been so much higher when the bulk of our energy is around all the things that could go wrong, and even the things that are improbable. Like when I ran a very big entertainment company, it was around the Super Bowl in 2010, 2011, we signed the biggest acts in the world. The Black Eyed Peas were the halftime show, Sports Illustrated. I'm aging myself, but we streamed. We're the first event to ever stream on MySpace,
Yeah.
to
Yeah.
thousands of people. And we strategically executed at the highest levels imaginable. And then the biggest ice storm in the history of Texas wiped it out. And I say that we still did the party monetarily. I went to sleep with millions of dollars in my account, woke up negative 800,000. My point in telling you that is planning for the unplannable and looking through a vantage point of you are going to be wrong. If you can have the actual intelligence and the humility, which is also intelligence, to say, I'm going to be wrong. But guess
Mhm.
what? If you strike out 7 out of 10 times in baseball, you're in the fucking Hall of Fame.
Yeah.
Like Michael Jordan lost 48% of the games he ever played. Like, so it's not about perfection. It's about progress, and it's about being wildly honest and transparent that things will go wrong. But if you go in it like that, with that approach, you'll create buffers and create hedge fund. That's what it means. You hedge your downside to cap what you're going to make on the top, and you have these good risk adjusted returns in the middle. But that simple mentality around it, from the scaling point of getting great people, to work on the projects that are in their core competency, speaking their own love languages, their own emotional intelligence, their own empathy pieces, along with the subject matter expertise to scale. And then you really focus that things will go wrong, not if. Those few things would have saved me a lot, and definitely now, save us billions and billions of dollars of future cash flows.
Well, let me just say a couple things. One of my most recent guests was about the first person online doing physical training, Michael Lassert, and now we have back-to-back episodes of folks talking about MySpace, because that's where he started his business, was online fitness training with Tom on MySpace. So that was number
Bro,
one.
that's too much gray hair, dude. Let's not. Yeah, my oldest daughter, like, Dad, you're old. Dad, you're old. I don't want to hear it.
Yeah, and then the second part was, believe it or not, my sisters and I, we sang "Where Is the Love" from the Black Eyed
Let's
Peas in the
go.
talent show. Man, I can still rap that
Let's
whole
go.
song. So
Let's go.
I
Let's
love it, man.
go. Look, we still had the parties. They were, and by the way, I'll tell you another thing about what could go wrong. This is in the book too, but
Yeah, let me pull that up.
I was playing poker with Hugh Hefner at the Playboy Mansion at a charity event, and at the table, Jamie Foxx was there, a bunch of folks. It was one of these, like, charity kind of things, and um, I wanted to rent the Playboy Mansion for a party, because
Yeah,
that Super Bowl was the Black Eyed Peas in Dallas, which was, I was living at the time, and then NBA All-Star was in LA that year. Okay, and so we signed Snoop Dogg. So think LA 2000. I mean, Snoop Dogg now at the NBA All-Star game in LA would be fire. Imagine in 2011. So it was, and Nate Dogg was performing before he passed away, and it was insane. It was insane what we had signed up. And Hefner wouldn't rent the Playboy Mansion as a general rule. They did from time to time, but we got to know each other at the table. And I basically said, if I beat you on this hand without looking at my cards, would you let me rent the Playboy Mansion? And mutual friend, luckily came up and was like, no, he's not kidding. Like, whatever. He's like, what do you do? I was like, I don't know. We'll donate 10 grand to the charity if I'm wrong. But if we do, we want to rent it, and we want Snoop to perform, whatever. Long story made long, I won the hand. He let us rent the Playboy Mansion after the ice storm had hit Dallas, mind you. So I'm already, like, licking my wounds in a
yeah,
corner after getting smoked. We rent the play. I'm like, this is fucking, we're killing it. We're selling tickets for 2,000-3,000 a piece. Tables are 50 grand. I'm sitting at home. The whole thing is cooked. Events in 2 nights. I'm watching the news in LA. Breaking news: Legionnaire's disease breaks out at the Playboy Mansion. Whole event's canceled, and we moved it to the Conga room. My point in telling you all of that is, one is, you got to keep going.
yeah,
But if you can do anything in this business at the highest levels imaginable, keeping those cash reserves, keep planning for things to go wrong that you don't even know could go wrong. Like, so, by the way, imagine if you're in the middle of construction, all the stuff happening in the Middle East, steel prices go up,
yeah,
shipping costs go up.
everything. Yeah,
You didn't get that GMP on your construction, but imagine rates. Imagine not getting a rate cap in 2022, and you have a construction loan at 5%. It spikes to 9 out of nowhere. So these things do happen, and the ones that are here, that are running the marathon, that are keep going, in my mind, use failure as feedback, but more importantly, plan for the unplannable. It sounds ridiculous to say, but if you think about it with your team and you actually say to yourselves, what could go wrong here that we're not thinking? You know what? We should save a little extra money. You know what? Like, call that guy again to make sure we're getting the contract. And that mentality alone, I think, has added billions of dollars to our shareholder value.
absolutely. Well, one of my favorite quotes from Ray Dalio is, "If you worry, you don't have to worry. If you don't worry, you better be worried," right? We do have a listener, Bruno. I don't know why it's not showing up, but Bruno says, in the sector of long-term investing that you're in, what do you think about building relationships with people online that leads to a successful business deal? And I do not believe Bruno is in the United States, so that's probably why he's
Bruno,
asking.
I love it. Let me tell you
Yeah,
something. You have to know the parlance of your times, okay? And in this day and age, I assume you're a young person. that's thinking about this. This is the language of the youth. And we're about to have the largest transfer of wealth in the history of mankind from the boomers to the millennials. So what I said earlier about the pensions and this and that, knowing your audience, if you know your audience that are at 65-year-old, guy in East Texas, you don't want to DM him on Instagram. He's not on Instagram. But if you're
Right.
talking to a group of crypto investors and whatever, I'm just using that have money and they're legit. Yeah, talk with them, like their posts, build their. So you
Mhm.
have to know your audience. So to the point of if the audience that you're talking with, that is their modality of trust building. You have to meet your customers in their domain using their language, using the rapport building skills, using your etiquette, using your clothing, using the things that your customer could get comfortable with you, and ones that are inherently online. In that instance, it's a beautiful modality. But if you're trying to reach, an 80-year-old lady that was a casino magnate in Las Vegas, I don't think LinkedIn is your way of going about building a relationship with her. You should show up at the coffee shop she likes to go to and pay the guy $20 to know what her favorite cookie is and show up there and sit with her. I'm just,
Mm.
so using the generation, using the culture, using the language of your audience is always going to be the best way to build real rapport.
Absolutely. And Bruno, I really appreciate the question. Ari, I really think that's a fantastic answer. You know, what artificial intelligence has allowed me to do is take my mind, which is long form, lots of detail for a lot of people. Everybody wants to read this, right? No, they don't. And use presentation technology like Gamma.app, and I drop my whole book that I just wrote into a presentation and I say, give me 4 slides. And then I send these 4 slides to people. I have gotten more responses from owners, from investors, from people to be on the show. If I was willing to do the work up front, do the research, like Ari mentioned, but then give it to them in a way that is digestible and that they
Yeah,
want to consume it, right? That's huge.
right.
Is
You have to know your
absolutely
audience.
critical.
Look, real estate, another thing too that goes, that, and I've said this a bunch, is real estate is about people, whether it's the investors, the equity, the homeowner, the
Mhm.
owners, the landowners, the brokers. There's a person at the end of that. And again, AI is a phenomenal tool. It's a great, but that's what it is. It's a tool.
Tool.
It's not the thing, and a gun is a tool too. You can hunt for your family or you can use it like a psychopath, but it's just a tool. And so how you utilize it to best get into your audience, again, it's about trust. Building relationships is the fundamental pillar of real estate. And it's been like that for thousands of years, whether it's families and monarchies, whether it's getting to know some landowner in your city, whether it's the broker that gets all the listings on that, you have to, in my opinion, in a world that is filled with noise, as you said, I don't think it's just about clarity. I think it's about coherence. And
Mm.
when you make something coherent for them and it's clear, then it registers. And when it registers, then you get the privilege of building a relationship. And once you have a relationship, the business builds itself.
Boom. All right. Well, we're coming up on time. I want to get to our quick takes with Ari. If you've got a favorite book and podcast that you can share with the listeners, please do.
Sure. I favorite book. Oh, that's tough. I mean, for this type of discussion, Think and Grow Rich for me it was the book that changed my life.
Yes.
Um, and I was an English major. I'm the guy that reads the classics. I'm reading Dostoevsky and reading Emerson essays, and like I'm a nerd. I mean, I like to read the classics. That's me. Podcasts. I really love the School of Hard Knock guys a lot. They're wonderful friends. They're here in Austin. We did a great thing together. But I love the way for the type of people that are watching this show of watching some of the greatest entrepreneurs in the world and hearing their stories has been really beneficial for me. And they're such great guys doing it. And like you, they've worked at it for years and they're getting their flowers. So I think everybody can get some value there.
Wonderful. Is there any trend that you're seeing in real estate right now that people are completely underestimating?
Well, I think one of the biggest trends is the debt wall that we're hitting. We have $1.5 trillion in office loans that are not going to be able to refinance because cap rates are so inverted. And I think we have a mountain of debt that has been extended and pretended for so long that there's going to be some kind of reckoning. And like you said, if you have, what was it, capital, courage, and what was the other thing?
Long-term perspective.
And long-term perspective, I would go in and start looking at buying debt instead of buying assets, and then being able to get things at a fraction of replacement cost. And when the market inevitably turns, which it always does, you're going to be in a very, very, very powerful risk-adjusted return environment.
Love that. You've shared some things about what you wish you would have first, known if you were first starting out, but maybe something we haven't covered yet. If you could go back, 15 years and commercial real estate speaking, what would that be?
Well, I think it would be all around how you're a custodian of capital. I think that
Mm,
is the absolute most overlooked thing and is so freaking important that go and find a great CPA, make relationships with great real estate lawyers. If you can find a fund administrator, or someone that you can really be super smart and make your competitive advantage, how you custodian capital, how it goes into escrow, your subscription agreements, your partnership, your quarterly reporting, use higher levels of transparency, explain those things, but how you hold money, how you distribute it, get audited financials, for God's sake, get audited financials. It keeps you smart, keeps you out of trouble if things go wrong. But most importantly, over time, when you have that for 3, 4, 5, 6 years, the big institutions will look at you totally differently because they'll know you're a consummate professional. You're not just a deal junkie.
yeah. Well, you mentioned one of your children. I do believe you have three, if
I
that's
do.
right. Yeah. So I did do my research. I've got three myself.
God bless you.
What's the legacy that you ultimately hope to leave behind?
No, I don't think about legacy too much, in that sense. What I want for my children, if there's one thing that creating this much, wealth will do, is for them, my hope is to have the freedom and the courage to be unapologetically themselves.
Mm,
And back to, like, my dad, and God bless him, I talk to him every day. um he had a path for me, and Lord knows in hindsight he was right, because I didn't know what I wanted to do per
sure.
se, and he kind of put me on a path that he knew was going to be something. But my greatest wish for my kids is not to follow what I'm doing. If they want to, great, but I want to create an environment and create access for them and create courage and confidence them, and so much that they could find their unique gift, no matter what that is. Being a chess player, being a singer, being a doctor, being a landscape, whatever is uniquely built for their superpower and their gift from God on this earth to do. I want to create an environment that I can support them to be that.
Love that. Man, I'm just getting the chills over here, just getting it just psyched up listening to it. Okay, we put your book up earlier, The Gift of Failure. We didn't get a chance to talk about it, but if you wanted to point people in the right direction, follow you, learn more from the Oracle of Austin, where do they go?
You can go to Amazon. I mean,
Yeah.
Amazon is there. You can look it up, and you can find me pretty easily on LinkedIn, or at Rastegar on the socials. I deleted all social media off my phone in 2019, so I don't do any social media personally. We have a great team that manages it, looks at it. They do their best to put out stuff, and we pride ourselves on your call will be answered. So if you message us, you talk with us, somebody is going to respond to you, whether it's a client, investor, something. And you can find it. And the thing about the book too, whether the book is worth your time or not, that's another discussion. But I put a recommended reading list at the end of it that I'm very proud of, like that I really curated a list of about 20 books, from stuff from Dalio, from Buffett, from
Mhm.
Tony Robbins, mindset, health, wellness, that even if you didn't read my book, I will say the $10 or whatever on Amazon, that reading list, if you just read those books, it'll tell you the bulk of what I think, that I think I've learned so far in this lifetime.
Ari, thank you so much for spending time with us on a Friday afternoon. I hope you have a wonderful Memorial Day weekend with your family and everybody else listening in. We appreciate the questions that came through. And if you want to learn more about Kansas City commercial real estate, head on over to www.mwcreadvisors.com. It's been another episode of the Kansas City Commercial Real Estate Market Pulse with special guest Ari Rastegar, dropping lots of knowledge. I'm going to call it knowledge bombs from his brain plane today, this afternoon. Ari, thanks for being here.
Thanks, bro.